Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to cover the smoke and mirrors, is what is known as the 30-year mortgage. So a lot of people, they get fooled by how the mortgage works because they see a low number like 6% and they don't understand the meaning of 6%, what that actually means for you. And so here we're in this video, we're going to discuss the first monthly payment, how much you're actually paying in interest compared to principal on that monthly payment. And if you don't know the terms, principal is the actual loan amount that you're paying off versus interest, which is the bank's profit. So before we go into that, let's just quickly take a look at this article here. It says that the FHA, the federal government, is greenlighting 40-year mortgages. And so we have a realtor in Florida that says if it helps people get into a house, it's a good thing. Now we're going to uncover that smoke and mirrors, and you give me your opinion if you think that the 40-year mortgage is a good thing or if you're being bamboozled. Okay, so let's go into our little cheat sheet. So first, I want to discuss when it comes to the monthly payment, the formula that they have for the monthly payment is the most complicated part. So you have this formula right here that I would not be able to produce off the top of my head, but basically it's a formula that includes the length of the loan amount, and the interest rate. So it's saying what is the exact monthly payment that I need in order for the loan to die at this term, at this for this loan amount, and at this interest rate. It's a very complicated form. Don't try to figure it out yourself. Just use a mortgage calculator app or website or Excel sheet or whatever, and you'll figure it out. But when we're looking at this, right, we get that monthly payment, and we have to ask ourselves, okay, how as a bank, if I were the bank, how would I maximize that profit? First way we maximize it is that if we get a higher interest rate, then we're going to make more money. So higher interest rate means a higher monthly payment. And let me actually write that down. We're going to put higher monthly payment. Higher monthly payment. All right. So if we have a higher interest rate, we're gonna make more money. But a lot of people won't like that because they're gonna see a higher monthly payment. Now, if we give longer terms, so instead of a 30-year mortgage, we get a 40-year mortgage, the bank's gonna make more money. And this is almost a more deceptive way of getting more money from the borrower, right? So think about that, right? So we have a news article that says that, hey, the bank is giving you a product or is offering a product that'll make them more money, but the realtor is saying, hey, if it just gets you your hope, that's a good thing, right? So you gotta kind of figure out what's people's agenda. Okay, so let's just do a quick example here using our Excel mortgage calculator. And so now let's just do a quick put in the numbers of $200,000 at 6%. And we see that the total interest, so two things. The monthly payment is about $1,200, right? So to most people, that would be pretty good for a $200,000 loan. They see that number 6%, they say it's doable, but then they don't really see that the interest, what the total interest is that they're paying, which is more than 100% of the loan. So at the end of the 30 years, you're going to pay more than 100% in interest. So they see the six and they get confused. How's that get calculated, right? And so, okay, so let me just write these numbers down. 1199.10. So this is 30 years. And let me put in the interest at 231,676.38. Now, let's compare the difference between 30 and 40 years, right? So if we want to see the scheduled number of payments, set the scheduled number of payments, 40 times 12 is 480. So I'm going to put 480. I'm going to put 480 here. And then we see that we basically pay $100 less, about 100, almost $100 less when we increase the term. And so to the average person, they see that, and just like that realtor we saw, it's like, man, it'll make living cheaper, more affordable. You'll be able to get in the house. But now let's take a look as to how much interest you're paying. So 295, 273.11. And so going from 30 to 40 years, even though you have a lower monthly payment, you're getting a heck of a lot more interest, right? So about $60,000 more. And if I have, if I were a really patient person, I probably would try to make the loan extend as long as possible so I can maximize the amount of interest. So it seems like the banks are willing to be a little bit patient, get $100 less so that they can get more return, more bang for the buck. So just be aware of that, right? So let me go back here. Okay, so we know that if we have a higher interest rate, that the bank will make more money, and if we have longer terms, that the bank will make more money. Now, I don't know about you, but it took me a while to figure out how does the bank make so much money if it's just a 6% interest, right? And then somehow that it goes to 110 or 120% interest rate. That's insane, right? So what we have to do is just do the calculation. So what we do is we get the monthly payment, right? So we plug, if you want to do it yourself, just plug in the formula or just use a cheat sheet like I would. So I would get an Excel calculator like this. You get it from mortgagecalculator.org, and you could, if you don't have Excel in on your desktop, you could always get the free version like I have here, right? All right. So let's assume I have a $200,000 mortgage. I got the monthly payment for this, and the interest rate is 6% interest rate. Now let's calculate how the first monthly payment would work and how it's split up between two things, right? So monthly payment of this 1199 is going to split up into principal, which is the actual loan that you're paying back, versus the interest. Okay. So if you look at the Excel calculator right here, you can actually see, let me just do this, 360, because we want to do 30 years, that it will actually split it out for you. So the first payment, or all the payments of the 30-year loan are the same. So it's $1,199. And you could see here that you only pay about $200 of principal of the actual loan amount and $1,000 of interest, right? So let's just go ahead and copy those figures. So principal and interest. So you pay $1,000 of interest on the first payment, right? Wow, that's crazy. So how do we know how much interest that we are paying? And it's really simple, right? So the way that it's calculated is you take the balance, right? So 200,000 times the interest rate, which is 6%, 0.6, and then you divide it by 12, right? So you divide by 12, and it might be off a cent or two just because there might be some estimation going on. So 200,000 times 0.06. And also one thing I want to mention is that the 6% is an annual interest rate, and that's why you divide it by 12, because 12 gives you the monthly interest rate. So divide by 12. Oopsie, made a mistake there. So let me just do it one more time. 0 times 0.06 divided by 12, right? And as you can see here, we got the interest. So the banks are being truthful that it is a 6% interest rate, but not really, right? Because they're not telling you how each calculation is kind of done. So as you can see here, I got the $1,000 of interest. And so what happens is that because they have this fixed monthly payment, what they do is they get, so let me put interest here. They get the monthly payment minus the interest. So, and that will equal the principal paid off, right? So it's actually in the best interest of the bank to have the monthly payment as low as possible, because even though it's a low interest rate, like 6%, because the monthly payment is so low, most of it's going to go to interest and you're going to pay out very little principal. Very little. So now all I have to do is just do a 1199.10 minus $1,000 of interest. And then now the principal is 199.9. And so now this loan will only go down by a little bit under $200. So if we go in here, about $200 of principal, $1,000 of interest, and look at that. Look at the ending balance. So when you make that first payment, right? So let's just do this in percentages, right? So 1199.10, that's like the actual payment amount. And let's do this. So 199.10 divided by 1199.10. And so 16% goes to principal. So let me just do that. 16%. And how much is actually going into interest? I'm pretty sure it's just 100 minus 16, but let's just do the calculation directly. 0.1199.1, and that'll be about 83% or 84%. Okay. 84, let's say round up, 84%. So as you can see here, that when you make the first payment, you're slowly chipping away that loan. And because the monthly payment is so low and you're having a small interest rate, but on a very big loan, that's why you're paying so much interest, right? Because so little is paid off in the very beginning, and because of that low monthly payment. For folks, a low monthly payment is not really your friend. People think it is, but it's really not. And let me just kind of show you here. So let's say I actually make this into a 10-year loan, right? So let me put 10 years here, 10 years. And 10 times 12 is 120 months, 120 months. So you can see, according to what the average American sees, when they see that big amount, of course they want a 30 to 40-year loan, right? Of course they do. But look how much interest the bank pays. So 66449.20. So if you ever think that the bank actually wants to charge a high monthly payment for a mortgage that's lasts only a short amount of time, you are mistaken. They want a very, very long loan where you pay a low monthly amount, but you pay a very long time. And the longer you pay, given apples to apples, they're going to make a lot more money. I mean, think about it. Would you like to make almost $300,000 in profit over 40 years versus about $66,000 in 10 years? I would rather go for the second option, right? I definitely would want, if I were the bank, I definitely would want the borrower to have a low monthly payment. Low monthly payment is the reason why the interest is so much, even though the interest percentage is small. But when you break it up, you're actually paying 84% interest on the first payment and only 16% of principal. So this is the part that's shocking. Like, let me put this in red so you know how shocking this is, right? And then this will be in black, but you can kind of see that, wow, 84% of the first monthly payment is going to the bank and 60%, only $200 going to loan, right? And then now you have to just repeat that. So once you've done the first monthly payment, you just rinse and repeat over and over and over again for 359 more payments. And then you'll be able to understand how we thought we were just getting a low payment with a nice interest rate to insane profits for the bank. In fact, as I'm doing this video, it kind of makes me want to be the bank, right? And maybe I will be. Maybe I will be. Maybe I'll be able to sell houses just like a bank one day, but I'm not there yet, but hopefully I will be there. Okay, so this is very shocking, right? So I got that shocked clickbait face on the thumbnail. If you're interested in joining our group and being mentored, feel free to click the Google form link below in the description, or you could send us an email inquiry. You can find our email in the About section of the YouTube channel. Just send a shout out saying, hey, I'm interested in joining your group, and then we'll set up a time to see if you're a good fit. And if you have any questions, comments, leave them below in the comment box, and we'll see you all in the next video.